While Mr. Reni joins us back, I hope you can see my screen. Everyone can see my screen. Hello? One of you can unmute and tell me.
Yes, sir. Yes, sir. We can see.
Yeah. So as you can see right here, Nifty tried to touch this red line over here, which was at 17,348, as you can see in this chart, and that was the resistance, and that is the point exactly from where we saw 57 point negative Nifty move on a very positive day, which was last Thursday, and Nifty ended at 17,287. Sir, I'll request all of you to mute. Okay. And once Nifty is able to cross this, the next major resistance will be at 17,487, which is right over here. And above it, then Nifty will have resistance at 17,615. Above that level, 17,782 is a major resistance, and it will take some doing to cross this resistance, which is at 17,782. On the downside, by chance, if Nifty faces some resistance at some level, then we will have support at 17,142. Below that, the support level will be around 17,050. Below that, we will have support at 16,814, which will be a major support. And below that level, 200 EMA of 16,701 will be a major support. We thought that we'll talk about the indices and all till till the technical problem that we were facing with Mr. Reni's connection gets resolved. I'll just try to talk to him just a minute to find out what went wrong actually. He was there and then his audio was a problem, and then something happened and he got disconnected. I'm really sorry for the inconvenience. Just he's on the. So there was a short power failure at Mr. Reni's end. He is just joining us back. So this is how I feel the position of Nifty is. Thanks for joining in big numbers, and I think Mr. Reni is back.
Vishal, am I audible?
Yes.
Okay, great.
We
can start it. I am sorry.
So power failures are rare in Gujarat, but when we decide to have, some guest or dignitary on our show, such small glitches are mandatory. वो कहते हैं ना चांद पे दाग होना चाहिए वैसा. So welcome back, Mr. Reni.
Thank you.
How are you today?
Well, absolutely fine. Had my workout and now I am sitting here having a talk with you. I think so. Since the last talk, so much has changed in the world. Macros have changed completely.
A little more loudly, Mr. Reni. There is still some voice issue, or you can bring a mic close to your.
Okay. Am I clear now?
A little better.
Am I audible
now?
Yeah,
this is much better.
Okay. So what I am telling, since the last meeting that we had, the macros have changed too much in the world. We didn't expect this much change in the macros. Ultimately, I think so 7 or 8 months back, there was a delusion in the market how much the macros can affect the equity. But I think so now people have come to understand there can be a changes in just some couple of days or a couple of months. Everything can get changed. people 8 to 9 months back, people were thinking, no, equity is always hunky dory. Nothing can happen. Am I getting audible? Am I audible?
Guys, it is just my problem, or you can just type in the chat box if everybody is able to hear Mr. Reni properly.
Or should I change my audio?
I think right now it was much better, Mr. Reni, when you kept it very close to your face. Or
Okay.
it will be, you can try changing the audio.
Now am I audible now?
Yes, now okay. Now okay.
Okay, great. Okay, so what I'm telling, macros are very important. If we remove macros from our investment scenario, anything can happen. So considering macros, I will tell you in the next 6 months, we will be facing a lot of macro events. It is possible. There is a lot of things that can derail whatever investment plans we are making. So we need to be very clear about how long our equity investments are going to be there.
Mr. Reni, as soon as you are leaving the mic, I think the audio is getting disturbed. So probably.
Okay. Am I getting clear now?
Yeah, this is better.
Okay, great. Okay. Yeah.
Yes, so we get the crux of what you are saying, that macros, global macros have changed a lot. Global as well as the at a local level, there are a lot of macros which are working. And 6 months back, people were, not aware that such catastrophic things can happen in a very short time, and they can disrupt the whole growth or whole progress or whole economic movement of the world. Especially because we had a big black swan event, once in a decade event in 2019-20, which was COVID. And then having this kind of another black swan event is, a little bit rare thing to happen. But as you said, that things happened in Ukraine, and there are some other things because of which the market may get affected. But what do you say? You still believe that India is a buy on dips market, or at current levels, do you think that long-term investors or medium-term investors should be looking to optimistically buy some stocks or hold on to their stocks? Or how do you see what should be the approach of the investor?
Frankly speaking, if I look into the East Asia market, India is a part of the East Asian market. Among the East Asian markets, still India is very expensive. Well, that can tell one thing: the expectation from the world markets again in India is too high, and there is nothing wrong in that. A lot of bet goes on because if you see the explosion of the middle income in Indian market has grown tremendously. I will just give you an example of the housing market. The housing market, 10 years before, the housing market was in the bracket of the middle income housing bracket was in the range of around 6 to 15 lakhs rupees. You would not believe the middle income bracket of housing has gone from that region. In just 10 years now, it is from 35 to 50 lakh rupees. So that is a 4 times jump in just 10 years. We can expect that is a 15% CAGR if we are calculating in the 10 years. So that is the exponential growth in the housing market in the middle income group. And I think so in the last 10 years, you will not have, you would not have found this much movement before that 10 years, 2010 or 2001 or 9, even I think so 1980s or 2000. There was not such a movement in the housing market, frankly. So last 10 years, India is growing, and let us believe India still has a lot of growth opportunities comparatively to other developed markets. You can see the earning incomes as disposable incomes comparatively has grown too high earlier. As I talked earlier, if I take in the sense of the largest car market in India, Maruti, which has around 50 to 52 more shares. If we take their one of the vehicles that was really a hit, Maruti Zen. Okay, Maruti Zen Maruti then had uh, around, I think so, 7 to 10 years of lifespan if for a family. But currently, if we take other vehicles from Maruti, the lifespan in the same family, it is around 4 to 5 years. Means the vehicle is getting changed in 4 to 5 years, 5 years max. So that is the huge, tremendous miss. Suppose let us assume a vehicle where that was getting changed in 10 years, now you are getting changed in 5 years.
5
That
years.
is a tremendous scope for growth in the market. So yeah.
So still India is a market which you would like to invest in, and you would like to go long, and you would like to tell our investors that they should keep investing.
Absolutely, because I was sitting on 30 to 35% cash, and during the Ukraine crisis, when there was a correction of around 10%, I invested in some good stocks where the valuations were very cheap. Okay, yeah, valuations are expensive at some counters, but not that much. There were many counters where the valuations were extremely cheap. And in this period of 1 month, I might have made around 10 to 15% return on my investment. No, that is asking too much. That is a pretty good return. I think so. 1 month you are making 15% return. What more do you want?
Absolutely. So my next question, Mr. Reni, this evening would be, as you said, that there was some valuation related issues. Some products some stocks were valued at quite a premium, and some stocks where valuations was cheap. So, lot of people look at valuations from the perspective of PE. And PE hunting, when a market crashes, PE hunting, price to earnings hunting, is what a lot of people do. Sometimes we know as investors that we have seen 3 bull and 3 bear cycles. I mean, you and me. And we know that sometimes PE hunting, I would like to hear from you about PE hunting. I'll give my opinion later. But valuations, PE, PE hunting, what are your opinions in such a crash when people tend to go for low PE stocks?
Vishal, if I talk about the stocks that I hold at a PE, it would be very hard for you to believe how can Reni be holding such expensive stocks. One of them I am holding since a long period. That is 3M India. Okay. If you talk it in terms of PE, it may be around 105 or 107 or 110. Probably at the TTM. Another example is the stock that is Maruti Suzuki. Now, if I take Maruti Suzuki at the earnings of this current year, around 107, I think so it is going around a PE of 71. Now, I will tell you why PE hunting is very wrong notion for investment. Let me just give you a simple example. I am just taking the Maruti Suzuki India Limited. Now, 4 years before, Maruti Suzuki had earnings per share of around 230 rupees. Okay, that is, I am talking about 2018, not far away. 230 rupees its earnings. So now, if I take that into calculation, Maruti had every company, every motor company in India had its issues due to chip. There was a underproduction of chip. Many vehicles where the production got delayed due to the semiconductor chips not available, and it was a very huge. Now, if I talk about the chip issue, can I say the chip issue will stay for 4 years, 5 years, 6 years? No. That is absolutely bullshit. The semiconductor issue was for a period of 6 months, so it can run another 6 months. But then again, Maruti will pick up, no doubt about that. So that was one of the big. Now, if Maruti from the current period, it goes back to its earning around 230 rupees EPS. Suddenly, what happens is PE falls to 28 or 29. Now, Maruti is cheap. The stock that was expensive just 6 months back, now it is cheap on the PE ratio. So those who might have thought, okay, at 71 Maruti is expensive, I will not invest. Now what he will do? he feel it is. So the notion is absolutely wrong. PE hunting, I will tell you, low PE stocks, people have a low PE is a for majority of the investors. I will tell you, many investors have lost some good stocks investment. I will give you example. 3M India is there. Then DMart is there. DMart is one of the exceptional stocks that has given very great returns to its investors. Another is one I think so we had discussed last time. That was L&T Infotech. Another company is L&T Technology Services, which is into design of plants and other things. At the current earnings, it is still at a PE of 52, 53. Now, if some person who is just on a PE hunting, he may not invest. But I will tell you frankly, just 3 or 4 days before, I bought some L&T Technology Services in some of my clients. Because I am just not looking at PE, I am looking at what the business is driving. If you take the 5 years business of L&T Technology Services, it has grown its revenue around at least 3 to 4 times in the last 4 years. So look at the revenue growth. Now, if the revenue is growing, naturally the bottom line, that is the profit, has to increase. Now, tomorrow, if I am talking about from the revenue point, in the next year, the revenue increases by 50% and the profit also increases by 50%. What happens? Suddenly, the PE of 52, it comes down to 25. And next year, same 50% if it increases, the PE suddenly from 25 to it will come to 12.5. It becomes very cheap at that time, at that point. But you have not invested earlier because at that time the PE was 52. Price to earning as a single denominator factor is absolutely catastrophic for any type of investment. I would tell the first thing, don't look at PE. Look at price to earnings growth. PEG is a very good statistical data instead of PE. But PE, I would not touch it. I would never look at a stock with a single aim of a PE, and I don't look at price to earnings. Majority of the investors, those who are new to the market or those who have been even old for 6 or 7 months, अरे इसका PE क्या है? अरे ये 5 के PE पे available है. अरे ले लो 5 के. Look at what the growth the company is doing. Is it doing or not? Absolutely, that is very important. And PE hunting, the person will get hunted. PE will never is never going to be hunted. The person will get hunted if he is going after the PE.
There are some intrinsic industries, they have a very high PE. They operate at very high PE because of the growth trajectory that they have in our country, right? Or in a particular market. So if at all investor wants to look at PE, he should also look at the industry PE. If you are picking at a pharma stock, look at the industry PE of pharma as an industry. If you are picking an IT stock, you have to, it is not PEG.
No, he is correct. I think so.
Okay. I read something else. Okay. So if somebody is looking at a particular industry and PE related to industry of that particular company, then still it is okay. But looking at PE of an IT company and looking at PE of an FMCG company and looking at the PE of an oil and gas company, this can be a disaster. It cannot be taken as a single denominator for picking the stocks, in my opinion. I totally agree with you. And we'll go to Mr. Ravi's question now. From where to find PE to growth or growth?
Okay. Can I have the okay? How to see?
Mr. Ravi is asking how to find PEG, that is PE to growth, of what you were talking, the trajectory of PE.
Okay, if I can get the question personally, I can answer it because normally there is a formula that we need to do. So the formula has to be put up. So it is to be divided by the growth rate. Let us assume.
Reni, again, there is a problem with your audio. I think maybe if you can switch the audio. If you can switch the audio.
Am I audible now? Am I audible
Guys, you
now?
can reply. Maybe it is a problem at my end.
No, am I audible?
Maybe you all can hear Mr. Reni
Yes, yes,
properly.
yes.
Okay, then it is fine.
Okay. So, what is PEG? PEG is price to earnings growth. So let us assume, let us take the basic example of DMart. Okay. Now, can you consider DMart still in a growth phase? Yeah, absolutely. DMart, we can consider it as a growth phase. Tomorrow, DMart can open another 15 or 20 more stores, and that 20 more stores will help it in its growth because sales will increase. So what is actually PEG? PEG is PE divided by the growth. Now suppose let us assume you put a terminal figure of 15% as a growth rate for a company that is growing, or 20% for a growth. Suppose this year, if you are taking a growth of a company is doing 100 crores in revenues, you expect 20% growth for the same company. So next year, what it will do? It will do a revenue of 120% if you are expecting a growth of 20%. So how you will come to the P ratio? That is, whatever P is their current earning, it will be divided by the growth. That means suppose the P is 50 and the growth is 20. So you need 50 by 20. So that will give you the PEG ratio.
How much PEG is good? How many years is it forecasted? This is the next question.
Well, if I think so, many people might have heard of the discounted cash flow. A discounted cash flow is same like PEG, where we discount the cash earnings that a company do for 15 or 20 years and then come to current price where we can buy. So PEG forecasting has its own problems, I will tell you. You can't forecast too much into many things. I will just give you an example. Current, if you are taking the macros into consideration, or if you are tomorrow, if the macros don't allow, and suppose let DMart as a company we are taking, what happens? Suppose they are planning to open 20 more stores, but due to the adverse market conditions, they decide that they will not be opening 20 more stores. They will just open 5 stores and they will just check out. Now, suddenly what happens? We had expected a growth of 20% from 20 stores, and the growth comes down to just from the 5 stores. So our growth comes down to normally 2 stores. So that is a problem with PEG. We can have 4 to 5 years of forecasting for PEG. So that anything more than 5 years, I don't think we will be getting a good value by that. For 4 to 5 years is a pretty good thing. And as Vishal told, we need to understand what industry it is operating. That is very important. Now, if I am talking about the industry, we are talking about the steel industry. Okay. Now, steel industry has seen a resurgence in the last 2 or 3 years, but it is cyclical in nature. Same is with sugar. You have seen a change in the sugar companies' valuations in the last 1 year. But can you take a sugar industry on a PEG growth of 10 years? No, absolutely not. You have to see first in the basics. Okay, what is the industrial PE for a sugar-based companies? So you found out the basic rate. Out of that, you need to see how much growth an individual company is taking per year. That growth you can discount it for 4 to 5 years, not more than that. So as Ravi Kiran said, how many years we can forecast it? Anything I think so, a discounted cash flow can be forecasted for 10 or 15 years. PG growth, I think so, 5 or 7 years at the max. And you need to look at the company. Is the company new or is the company in a niche field? That is very important. You need to understand. Or is the company in saturated field where the growth is going to be stagnant after 3 or 4 years, even if it is coming down with a new product. So 5 to 7 years of PEG growth can give you a realistic figure of investment. Anything more than that, you are just hitting on the dartboard, I think so.
There are a couple of hand raised. I would like Mr. Viral to ask his question first, followed by Puneet. Viral bhai, you can ask your question.
Thank you very much. Thank you, Vishal.
Reni, I have a question for you. You started with upset in macro, and that is the right way of approaching investments going forward. Now, the question is that uh, US Fed has already, is roaring like anything, but, it has come out with a very mild increase. But again, it is roaring for another 5 to 6 increase in 2022. FIIs were showing bearish approach, looking to US Fed type of things, and they were just in a bearish mode, selling mode, and DIIs and local investors are now coming in a big number now. So if anybody says that we were not in panic mode in last couple of months, then they are fooling themselves. Yeah, I must say that. Correct. So looking to this US Fed and FII's behavior and the panic it created in the last couple of days or 1 month or so, what do you see the long-term story of Indian stocks now? Because people say long-term is always, if you see people are predicting 1 lakh Sensex and 2 lakh Sensex in 5 years, 10 years time. How do you see this long-term story?
Puneet,
And
carry on.
and how come you have a cash when in such situation?
This
How
is the
come
golden question. So this was Mr. Viral.
You
This
said I was
Mr.
sitting
Viral.
on a cash.
Yeah, please continue, Viral bhai.
So it is very difficult in a rising market to sit on a cash.
Yeah.
So I really don't, add what you stated in your statements. So what do you think the long-term story, number one, and how come you were sitting on a cash in a rising market?
So Puneet,
This is Viral bhai. This is Mr. Viral sir.
Okay. No, the question was asked by Puneet, I think so.
No, it was from Mr. Viral.
Puneet, it was from Viral. Okay. Mr. Viral, from starting, I will come to your question slowly, and at the last, I will answer why I was sitting on cash. Okay. So the first of the thing is the Fed. Okay. Now let us talk about the rising inflation. What do we need to understand how things goes on? We look at the history to understand the future. तो जैसे हम कहते हैं कि हम हमेशा मिरर में देख के बाल ठीक करते हैं. So why do you look in the mirror? Because that gives us an idea how our hair is looking or how our face is looking. So let us check the historic references of the increase of Fed rates in US. Okay. Now, last, when have you heard the inflation in US touching 6%? Now, you might have gone to the history 1960s or 70s. Before that, you might not have ever heard US inflation hitting 6%. Now, when you are in the range of 1 or 2% of benchmark rate and your inflation is 6%, technically speaking, on the benchmark rate, that rate of return is minus 4%. So what you will do, what you will try to do, you will naturally try to increase the rate. And yeah, Fed increased the rate by just 0.25 basis point. Now Fed has other duties also. They need to control the equity market also. If you take into the US market, 52% of the US market is invested in equities compared to the Indian markets of 4 to 5%. So even if there is some catastrophic problem with the equity market in US, it is going to affect the household income of an equity player in US. We can't deny that fact also. Another thing is we need to look at the 10-year yield of a US bond. I think so. Last, I didn't check out for last 10-15 days, but it was around 2.02 or 2.5, something like that. if this bond yield is increasing around 2.15 or 2.30, it is a serious issue for me. I will consider that into factor and I will again sit on cash. So, and the reason that US Fed didn't increase the rate at one go, it needs to control the balances, US market is also, equity market is very big. So suppose what happens if suddenly the money doesn't flow too much into the US equity market. So naturally the household income is going to get affected at that place also. So what happens? And I will tell you one thing. If you look over the world, the market, the central banks are very dovish in nature when increasing the rates. Because what happens? They also know if they are going to increase the rate, then growth is going to be affected. Anyhow, even if India, even tomorrow the repo rates or reverse repo rates are increased, it is going to affect the growth rates. So, how to raise the rates and not affect the growth rate? That is one of the primary issue with all the bankers, central bankers. So they try to increase the rates as minimal as possible and look at if there are some changes coming in, if the inflation is cooling down, if suppose let us assume instead of 50 basis point, 25 basis point, they are trying to bring down the inflation at 5 and 4%, they will be very happy. And then they will, but if that is not happening in spite of that, then they will go for another 25 or 50 basis point. So the first increase, I will tell you, the first increase is always very linear. World over, you take out the market, the first increase will be always linear. It will be there to cross check. They will check 1 or 2 quarters and then they will decide, okay, second increase we need. And that second or third will be 2 times the first increase. So second or third can be 50 basis point or it can be 75 basis, normally 50 basis point. But if you check out the history of India also, RBI, in the first basis, it has been always the repo rates have been increased by 25 basis point. So same has been with Fed also. And the markets, why increased? Because the 25% basis point was already factored in the market. There was a huge correction. If you look into the equity market, if you look into the Nasdaq index, there was a huge correction. All the FANG stocks had corrected 25 to 30% from their all-time high. So the correction was already there. And so that's why when the rate was increased on that day, you didn't find any negative surprises in the index at that time. Now going to the cash. Okay, I have been there in the market in 2007 or 2008. Sometimes, you feel, and I have a data for the last 15 to 20 years of the price to earning, the book value, the dividend yield of the Nifty companies and everything. So I sat on cash, not that much that I would have loved to, but I was sitting on a cash of 25 to 30% because I was not happy. I was not getting the worth, the value that I could invest in. Basically, the stocks that could grow at 10 or 15% or hardly 12%, they were also available at a, as you said, price to earnings growth of PE of 70 times. Now, if I need to factor in how much growth a company can make, there was DMart. DMart was there. If you take it, I think so. It went to a price of 5,900 or something like. I am still holding L&T Technology Services and L&T Infotech also, though it went to an high, but I was not comfortable. Now, I will tell you what difference does it make buying two things at a price. If I am buying a thing at 10 rupees, which was available at 20 rupees earlier, now if that thing goes to 20 rupees, I am already making a profit. We need to understand one thing. Make profit when you are buying a stock, not when you are selling a stock. And I make profit when I am buying a stock. So I will always make sure that the chances of me getting profitability at a price point where I am comfortable to enter into the stock. So I was sitting in cash. I was literally 25 to 30%. And it is very bad. Sometimes what happens, the whole world is making money around you and you are sitting around cash. And you need to hear a lot of things from your investor. And you can be wrong also.
Sorry to interrupt, Reni ji. Can you please explain what do you mean by profit when you're buying a stock?
Yeah. When you buy a stock, about the profitability, I will give you a very good example of a stock that was very beaten down. And I still hold it. And I am still very bullish on that stock. Jyoti Laboratories. I think think so. I am still bullish on the stock. Now, comparatively, when the market corrected to around 7 to 9% also, the price that I bought the stock, Jyoti Laboratories, I bought it at the price of 140. It is still at 140. I didn't make any loss. Now, how I am making profit when I am buying the stock, I will tell you. It is not about when you sell a stock and you make profit. You make profit when you buy the stock, because at what price you are entering is very important. Suppose let us assume you are entering into a stock at a very high price. It is possible for next 3 to 4 years you won't be making a single penny on the stocks. Last stock that I gave on our fundamentals of what's Ambika Cotton Limited. In 2018, Ambika Cotton Limited hit a high of 1900 rupees. After that, it covered its high recently, I think so. So for the next 4 years, you were not making any money actually on Ambika Cotton Limited. Now, I bought the same Ambika cotton at 800 rupees and I gave the clients here also around 900 or 1000 rupees. So at 1800, you are making profit. But assume the guy who bought at 1800 in 2018, after 4 years also, he was not making any profit. He will be making profit now. So that is what I'm telling. When you buy a stock, you should think of making profit. So that is what is important, at what price you buy a stock. As I said, you can't give a wonderful price to any fair company. There has to be some valuations that you need to give. More than that, you will be just sitting idly on that.
For example, Mr. Ravi, I will give an example. During the COVID fall, Reliance was available at around 850 at its lowest. So that was a steal. So when those who bought Reliance at 850 in March 2020, they made profit exactly at the time when they bought the stock. This is what Mr. Reni is saying. Ambika Cotton at 800 or 900 was a steal. When he came in our talk show last time and he said that, you should go for Ambika Cotton. So at 800, 900 rupees, it was a steal, So when those who bought that stock at 800 or 900 rupees, they made the profit exactly when they bought it. So it is not practically making profit when we buy it, or it is not something like you sell the short the stock or something like that. It is a way of saying, what he's saying is that buying at the right time, looking at the right mix of parameters and looking at different aspects.
If I may interrupt, and like what I understand is you should try to buy the stock in your oversold zone when it is in oversold zone. If I summarize, is it correct?
Well, that is a part. Many stocks go into the oversold category, but you need to look at the fundamentals also. If fundamentals have deteriorated, then no point in getting into the stock. For simple terms, I would like to give you the example of Diwan Housing Finance Limited. Okay, for a long time it was into the oversold category, but the fundamentals was completely, there was a lot of fraud happening. There was a lot of issues happening, so that needs to be checked out. Without that, any company in the oversold category, it will get out selling more and more. So that is.
So it is combination of lot of things, Mr. Ravi. It is combination of lot of things. Karthikeyan has pointed out that US bond yield right now is 2.15. That is, this must be after you were telling it around 2. That must be around the time when 25 basis point was not increased. Now it is 2.15. That is after the increase.
Yeah.
10-year US bond yield.
Yeah. 2.5. It has to naturally increase because the bonds will increase. Yield will increase on the bond as the rates get started up.
Puneet, I hope Mr. Viral's question was answered. Mr. Viral is an avid investor. He is someone from whom I personally learn a lot of things about the market. And obviously his question will not be easy to answer.
I would like to, Vishal, I would like to interrupt you. I am still sitting on a 220 per cash. I will just tell you.
Our next question.
It is Reni, it is very difficult to really sit on on cash, sit with cash
Yeah,
while the
yeah,
market
yeah.
is bullish.
Absolutely.
Bullish.
Absolutely.
And
Absolutely.
when the market is bearish, like for example, Vishal was telling March 2020 when Reliance was 875, people did not have cash to buy. It is a fact.
Yeah.
Price may be anything, but people run out of cash when it is a good price, and they run out of money when there is opportunity to buy. Really, this is what we have seen cycles and cycles after. The greed element is very important, is killing everybody.
No, it should be there in the market. Without that, how we people can make profit?
Yes, Puneet.
Okay, Vishal and Reni. Vishal, I've WhatsApped you the chart on which I wanted to discuss, get a clarification. So, Reni, actually, there is something called a Nifty PE chart ratio, right? Which shows us like 12 to 15 is the best buy time, 15 to 20 is a good. Then above that, it's like a risky investment.
Yeah.
So, sir, what do you suggest? Like, is this a benchmark to enter into a market, or should we stay away? Earlier, like previously, I believe Viral was talking about like people have not having cash in hand. They must have invested, or probably having cash in hand. They must have invested at a wrong time based on this Nifty PE chart ratio. So, what do you suggest? What do you have your views on this?
Puneet, if we look into the factors, we need to take the historical data, and as you said, the chart that has been prepared, I think so. It was Stable Investor. He's a friend of mine also who prepared that chart. Basically, the chart got copied from there from a long time. It was around 10 to 15 years back that those charts got prepared. So that was taken into the historical data. The chart was prepared up historical book yield, dividend yield, as well as the price to earning. And there was one more thing. Dividend yield was there. Price to book value. Price to book value. These three factors were there. So it is so after that the chart created was to give just an average basic idea where the investment returns can happen. I will tell you, even if you are investing at this price, the returns will be there 7 to 8%. But what happens, suppose you are investing at a lower price, your returns will increase commensurately for the same thing. So it is not like this. Suppose, let me tell you, today you are an investor, you have an outlook for the equity market. For the next 7 years, you don't need money back from the equity investment. You will make money at this point of time also. And be sure about that. I am sure about that. Suppose for the next 7 years, you don't want to take the cash out of it. You will make money from here. The returns may be a little bit less. It may be around 8 to 9% or 10% at the most. So that is there. But you will surely make return. And the returns would be far higher than what the inflation is getting projected in India. So whatever we are having the P, okay, that gives us an idea where we can keep our cash little bit, where we can invest. I will tell you frankly, sitting on cash is not an easy thing. I know once I sat on the cash for whole 2 years. That was 17. I was just looking foolish. I was for the 17 and 18 years. I will tell you, if I look at my data, I did not invest a single penny in that year. Not a single penny. So I may look foolish and I may go wrong also. Market में कोई कभी भी सही नहीं होता है. I may get wrong also in the future. But yeah, it has given me more chances of investment. If I am sitting on some handsome catches, it has given me chances. And I have got the chances. I will give you an example recently that I invested and I shared with Vishal also. The company name Hero Motor Corp. Okay. Due to the EV and other things, it got corrected heavily. I invested at around 2,450 rupees something. After that, it went to 2,300 also, but I was sitting. And then it went to 2750 something like that. I sold half of my holding and again I sat back on cash. because suddenly I was getting 15%, 17% return on just a period of 2-3 months. And again, I sat back on cash. Though I don't do frequent trading like this, but somewhere I felt, okay, the movement was very fast. So I will sit on cash. I will just give you one more example that Vishal gave you as an investment. That is Bombay Stock Exchange. Okay, we gave it, I think so, Vishal. What was the range?
540, 550.
550. Okay, so I think so, just a year back, and it is around 2,800 or 3,000. At this price, will I buy Bombay Stock Exchange? No, never. So why what I bought, I am just sitting on that. After the bonus issue, I may sell a part holding. That is a business sense of making profitability on taxation purpose. But I will not buy at this price. I can't get, for that, you need to check out what are the exchanges trading world over. So that will give you a fair idea at what price can I buy an exchange.
So it is more about comparing apple to apple, right? When I said that PE of an industry, PE of IT industry as a whole, and compare that to PE of a Birlasoft or a KPIT or a Oracle or a Alphabet or Infosys and TCS. So if you are talking about BSE, compare it to how the indices globally are trading. This is what Reni is trying to say.
Absolutely. I can't compare bananas and apples together.
Yes, Mr. Ravi.
Sir, when you sell a stock, how do you deal with this TDS? When you said you sold it in a month like 10, 12% or 15% in a month, but when you sell any stock, TDS is automatically deducted, which is like a 20% or something of the total value. Then you are on negative, right? Then how you are dealing with this kind of taxation issues?
No. I think so. You have got the things wrong. When you sell a stock, never TDS is deducted. TDS is deducted only on your dividend. Tax is never deducted when you sell a stock, I think so. That is the short-term gains of 15% that you make. That is from the gains, frankly.
That is on the profit that you made. You made a profit of 100 rupees. On that, there is some profit gain that is taxed.
Short-term gains.
Your TDS, short-term gain. Your TDS, because you are an NRI, Mr. Ravi Kiran, you pay, your TDS is deducted in the dividend that you get. Everybody else, it is more than 5,000 made in a company, only then it is deducted. Yeah, any more clarification, Raviji?
In ICICI, when I sell some is TDS, it is deducted.
Sir, come to Sher Khan. I have been telling you.
Excuse me, sorry to
Sher
interrupt.
Khan, open an account with Sher Khan.
Excuse me.
Yeah.
Sorry to interrupt. Actually, Jiroda also it is happening for NRIs. They deduct TDS.
Yeah.
Come to Sher Khan.
Well, the TDS is completely on the taxation and the broker part. So I would not be a right person to answer that thing.
No, it has been instructed for NRIs.
Yeah.
Wherever, even in mutual fund claim also, redemption also.
Yeah.
It has been instructed to deduct the TDS there itself.
So that is the taxation part that we can't avoid, But
Yes.
Okay,
yeah, but then
we will come back to you. See, Mr. Jitendra Dasani, who is our in-house expert on taxation, I will personally talk to him. And Karthikeyan, you are also in the group. Mr. Dasani is also in the group. Raviji, aap bhi group mein hai. So we will discuss in detail about this, and we will clarify this issue most definitely regarding the taxation TDS deduction of NRI. In my personal opinion, that should not be the case. That is something to do with Zerodha or ICICI. But we will make sure to get you a proper
Vishal,
answer from our in-house expert.
Vishal, there is a question and very interesting question from Ravi. With policy for BSc, sir, now to decrease. Okay, I would like to answer that question. before.
Yes, that is a very good question. We can take that.
Yeah.
Just a
Now,
minute. Raviji and Karthik, we will come back to this topic in our WhatsApp group. We will get you the answer for this TDS.
okay, for BSC, I think so. BSC is going to be exhibited in 1 or 2 days. Sorry, X bonus. That is for every 1 share held, we will be getting 2 shares. So, what I would tell you is, what happens when you get bonus shares? The bonus shares price, there is acquisition price is considered as 0. Okay. So what happens? Hold on to the bonus and we go by the first in, first out. So suppose, let us assume I will give, suppose you bought 100 shares for 200 rupees and additionally you got 200 shares more. So now you are getting 300 shares. So effectively what happens? You got 100 shares for 200. Now 300 rupees you have to divide the acquisition price for you. So basically what happens? Down. But when you sell the shares, according to the first in, first out method, your profitability will be that way you can bring down your profitability on taxation part, because as your acquisitions for 0, the profitability, high profitability going to will that region.
There was some internet issue and I think there was a buffer when you were speaking. So can you repeat this part? Very important part.
Yeah, okay. Now what I am telling, suppose let us assume you bought 100 shares of BSC at a price of 200. This is just an example. Okay, at the price of 200. Now the price is currently 3,000 rupees. So I am taking 1,000 rupees. Now currently the price is 1,000 rupees. What happens in a short term? If you sell, you will be paying the short term gains on 800 rupees. Okay,
Correct.
Got it? Correct. Okay, that is easy. Now in between, now BSC is going ex-dividend. So what it is doing, it is giving you 200 shares for every 100 shares held. So now you are the owner of 300 shares of BSC.
Correct.
Okay. Now as per the tax, the terms, your next 200 shares, the acquisition price for bonus shares is 0. वो 0 rupees गिनते हैं वो bonus shares का. ठीक है. अभी क्योंकि the X bonus, the stock has turned X bonus, what happens? The market price will get deducted by those 200. So now the market price will get divided among the 300 shares, not in the 100 shares. So suppose the market price is 1,000 rupees. So 1,000 divided by 300, what it will be?
300.
So now the market price is 300. Okay. So suppose now let us assume you sell stock 100 for 300 rupees. So now your short-term gains, initially it was on 800, but now it is on just 200 rupees. So ultimately, instead of paying tax, suppose on 800 rupees into 15 divided by 100, suppose you were paying 120 rupees as a short-term gains, on 200 into 15 divided by 100. Now you will be paying just 30 rupees as a short-term gains.
Okay. The point is taken. And we thank you for explaining this. So a partial profit can be booked once the shares are accounted in your account. Once you get the shares.
Yeah.
Okay.
I have
Now,
one question. Actually, previously somebody touched on this Nifty 50. Currently, there was one stock, good stock was swapped, like Apollo was swapped with IOCL, which was in Nifty. So how is it going to affect IOCL? Is it like negative for IOCL, or how is it going to be in the Nifty 50? Is it so important for IOCL to be in Nifty 50?
I will repeat the question.
Okay,
that some stocks
I
are...
got the...
Okay.
No, I got the question.
Okay.
No issues. Siva asked the question.
No, Ravi.
Ravi. Okay, Ravi, look, whatever index it is a barometer. If you now, as you told, can it be a negative? Yeah, it can be negative in the short term. What happens? Suppose some mutual funds who are mimicking the index. So what they need to do, what they will do, one company is getting added into the index, so they need to buy into that index company, and they need to sell the index company that has been moved out of the index. So in that matter, it can be a negative. Means there can be sellers from mutual funds. So it happens. It happens. Initially, it happens. But so, there are many chances also the company that have moved out of the index, they have made a good growth and they have come back and acclaimed their prices. Because what happens, sometimes some move up, but somewhere some value people find in a, suppose a company that is for a flexi cap fund. Flexi cap fund finds value, so they will come and invest into that. So negativeness, yeah, negative it will be when the index funds sells, or suppose a company is into an MSCI index or something like that. So negative will be there, but it is always short-lived, not long term.
Okay. Now moving on to the next and final question. As we said, as we are talking about P, is another very important point. Has always been dividend yield, and return on investment. So can you tell our audience the difference between dividend yield and return on investment, and how dividend yield is a part of return on investment and how you calculate it?
Okay, now among these things we need to understand first and the foremost, what is the face value of a share? Suppose let us assume the face value of a share is 2 rupees. Now the company declares 100% dividend. Okay. So what will be the dividend? The dividend will be 2 rupees because the face value is 2. So the dividend will be 2. Now suppose the face value is 10 rupees. The company declares 100% dividend. So now
that
the
will be
dividend
10
will
rupees.
be, yeah, now the dividend will be 10 rupees. So we need to understand what is the face value of a company. That is the first and the foremost thing. Second is, what is the return on investment difference and what is the dividend yield? Dividend yield is the dividend that is declared, that is calculated on the current market price. Now suppose you bought a stock for 10 rupees. It declared a dividend, the face value is also 10. 20 rupees. The face value of the stock is 10 rupees. The company declared a dividend of 100%. So that means the company declared a dividend of 10 rupees. Now the current market price, if the current market price is 50 rupees for the stock, what you need to do is you need to divide the dividend that you have got by the current market price. So that will be the dividend yield. Now let us assume you didn't buy the stock for 50 rupees, you bought the stock for 20 rupees. So on 20 rupees, if you are getting the 10 rupees, so the return of investment will be 50%.
For you.
Yeah. But the dividend yield at the current market price will be 10%. Okay, on 50 rupees. So it will be 20%. So what return on investment will be 50, but the dividend yield will be far lesser. So
Correct.
the dividend yield will always get lesser if the market price of that particular stock is going on increasing.
मैंने अपना वो रजिस्टर किया है जो तूने बोला एड्रेस
I think
रजिस्टर
somebody
करने के
by
बाद
mistake.
उसको एक्सचेंज भी करा रही है कि हमने अपने बुलाया उसको
Sir, can you mute yourself? Who is this? Okay. Yes, so good point made, Reni. And now coming to the final part, where you can give us 4 or 5 names like you gave last time, which you think will be excellent educational calls for coming next 2-3 years, where we can get 30 to 50% returns, which we had promised our audience.
Okay, I think so. Your clients have already made use some of money from the last stocks that I gave, and among them, one I would still continue holding. That is the consistent compounder. Consistent compounder is a stock that will go on compounding your money for the period of 5 to 7 or 10 years, Among that SCL Technologies I have already given. It is a constitution commander. I am still holding it. I will just share the screen. I think so.
I think I'll have to give you the right.
Yeah,
Just
give me the share screening. So I have prepared a PPT for the next 4 stocks.
okay. Now you can share the screen.
Okay, so this is the 5. I think so. I have written just 5 stocks, but I have just kept 4. I think so.
You can just go in screen presentation mode.
Yeah. Okay. Slideshow. Okay. Is this getting? Just a minute. Okay. Are you getting this?
No, not yet, but you can just put it in the presentation mode. Yeah.
Yeah.
But this
Getting?
looks fine. This looks fine. Everything is visible right now.
Okay, so I have just put 4 stocks. This stock I will give it to Vishal individually. So currently, among the already I have given Ambika Cotton Mills. The reason is I will still continue with Ambika Cotton Mills. This can give you around 40% return in the next 2 years more. Revenue growth has been around 14% quarter on quarter. Profit before taxes have grown around 14.14%. Earnings per share has grown by 13.9%, 95%. Would be bought at current price and can be added if opportunity arises to buy in the range of 2,000 to 2,100. This stock can go above 3,000 and 3,500 rupees also. So this is, I am still holding this stock, I will tell you. Though I have bought at around 800 rupees, I haven't sold the stock. I am still holding into this stock. So this is my first stock that I am giving it to the client of Happy Candles. So this can be bought by you. I'm moving on to the second stock. Vishal, should I move
Yes.
on?
Yes.
Okay. Second is Godrej Consumer Products. Brands like
We are just
Heat,
still seeing the Ambika Cotton screen.
Ambika. Okay. Done.
No, not yet.
Currently, okay.
You can just shift it manually, physically. Just click. Yeah. No, I think it is a dark screen right now.
Just a minute. Now you are getting it.
No, it is a now we can see Ambika Cotton. You can just take your cursor to the slide. Yes, click that. Okay, better.
Great. So
Yes.
now it is Godrej Consumer Products. Among them, brands like Heat, Goodness Me, Godrej Air, that is the car freshener. It is showing continuous growth. Sales have grown by around 13.95% in the last 12 years. The stock price has corrected nearly 33% from its all-time high, which gives a good reward to risk ratio. Expected return of around 30 to 40% in the next 2 years. Can enter at this price also, or and could add more around 650 to 680 range if the market gives the opportunity. Yeah, it will break its all-time high of 1120, or I think so 1120 it was high. I am still holding the stock and I have bought at the lower levels also. So this is a good company. This is the second company that I would like to give you.
Okay.
Okay. The third company, you might not have heard it. This is a small cap company, but
we cannot see this.
This is a
just
limit.
Click it again. No. In fact, we had given Acrysil some time back.
Okay, now this company is a quartzing manufacturer in India with German technology that is patented by Shock. It has entered into a strategic partner with IKEA for global supply and manufacturing of kitchen sink for their global requirement. they have enhanced their capacity from 5 lakh units from 2.5 in 2012. The current price of 805 can give a 50% return in the next 2 years. The best price would be around 600, 650. Mind to allocate 3 to 5% of my capital at this price also.
Noted.
And yes, so the next company that I would like to give to your investors is Motilal Oswald Financial Services. Now this is an investment company. It has around 3% market share in capital markets, around 1.9 market share in mutual fund equity asset under management. In wealth management, it services around 4,600 families. Profit has grown around 50% CAGR in the last 5 years. I expect a price of around 1250 in the next 2 years from the current CMP. Disclosure, I have invested into this company for me and as well as my clients. My investments have been very recent. So it is not like that I might have bought it around 700 and right now giving it, because I normally, whenever I am selling, telling it like that, so the investments are very recent. So this is one company that around 4 companies are there. There was one more company, but I could not prepare the chart for that. So I will just send it across to you in a mail, so you can share it with your investors. So currently,
No problem.
these are
You can
the
name the company. You can name the company, and maybe I can do a live chart about the same.
Okay, the company is VST Tillers and Tractors Limited.
Okay, just a minute.
I think
VST
so.
Tillers has been one of our HCI picks.
But I would still wait for a little bit the price to correct.
Okay.
I would like to enter into that counter around 2000, 2100, not before that. I have some small quantities, but not that much that would make a huge difference to my profitability.
So can you see the screen, all of you? This is a chart of VST Tillers. And as Reni says that the right time to enter the company would be around 2000. So 50 EMA is around 1950. So by chance, this is right now at a support. The support, as you can see, the green line 2416 or 2377. It is trying to make a bottom over there, and it can rise from here. Or if it comes down, because it is below on a daily chart, it is below 50 and 200 EMA. So there is a chance that there can be a correction. And if you get an opportunity to buy this around 2000 as per Mr. Reni, it will be a great
yeah, absolutely, absolutely.
Okay, so this is a chart. It had made a peak of 3469 somewhere in October, coinciding with the market peak of 18,600, and then market has corrected, and then VST Tillers has corrected, and right now it is trying to form a bottom. If you can see over here, around 2,300, 2,400 levels, and it is also part of the squeezing triangle. So if it breaks the triangles and goes on the downside, it can go as low as these 3 points. This is a major support at around 1900. There is another support at around 2100 and 2000s. So you can do a SIP buying once it makes a firm bottom and then starts bouncing from around 2000 levels, in my opinion. And it can go to 3000 and 3500 levels in a long term. Right, Reni?
Yeah, absolutely. The company is also planned on to fundamental. They are going to increase the revenues to around 2 times. So that will work on the bottom line also. So that is an absolutely
perfect. Perfect. So as soon as you share this presentation to me, I will share it to all the my respective groups, respective participants, and it will be our great honor and pleasure. It has been our great honor and pleasure, like always, to have you this evening. And although we are running out of time, I'll take 1 or 2 questions final, if you don't mind, Reni. because people might be
Yeah, sure,
quite
sure.
eager. Yeah, the floor is
Absolutely.
open, guys. You can ask your questions. Raju bhai, you raised your hand first.
Reni bhai, what is your view on silver in the future?
Silver. Well, I haven't studied this, so it would not be prudent for me to give any view on silver. Currently, I haven't studied. The last time I studied silver was around 2015. After that, I haven't just tracked it also recently. So I can't give you about the commodities. And frankly, right now, the current markets, I don't favor commodities except for gold as a standard support. I don't favor any other commodities because nothing is getting clear.
Okay, thank you.
I will try to do a chart for silver. Maybe later, Mr. Raju bhai, we will leave Reni out of this. I'll try to share silver's chart in our special group.
Thank you, Vishal bhai.
So if there is any other question, please let us know. Otherwise, we can close the day. We are already over time, and we have kept Reni waiting with us
Your
for.
views on, Sir Ravi here again. Your views on this Savita oil.
Sorry, I haven't studied it. So absolutely not possible to give the view because without studying, I don't give a view of any company. So yeah, I may take it as a consideration, but I may need some time to study the company.
Reni, good evening, sir. What is your view on crude oil?
Well, with these macro conditions, frankly speaking, to check about crude, it is fraught with some big issues. I will tell you frankly, because there is nothing in your control. Let me tell you one simple fact. Both the things can happen. Suppose what happens if this war escalates into the NATO region? The crude can help and it can go to 150, 170. You would not be able to control it. Now, suppose instead of that, let us assume the OPEC countries they decide to increase their crude output to support to keep the prices in the control environment. Then what will happen? Then the prices will correct, and by that time, if any favorable declaration comes for the war, then you can find the same crude around $85 to $75. So when there is lot of uncertainty, I would always tell people to just keep away from the counter because some things are not in your control, and when things are not in your control, there are a lot of chances that you may get sucked into that, and just you are playing like blind, nothing more than that.
We'll take one final question and then probably we can end this evening.
You want me to ask Ravi again? Or
no problem. Go ahead.
Yeah, sir. I think given this high uncertainty period also, Japan has come forward investing like $42 billion promising to India, and others are also trying to move away from these fossil fuels. Is it, can we take that the ESG investing will be like affected or will be pushed forward?
Ravi, first and the foremost thing is, there are many things that we think we know, but we actually don't know. Among them, I am also one of the person culprit because I may be knowing, I think I may be knowing, but actually I don't know. Now let us assume, do we know into an electric vehicle, the battery that goes, how much kg that battery is? What if I tell you in a normal car that may be around 1700 to 1500 cc, the battery weight itself goes to around 500 kgs. Out of that, now let us assume the battery that simple, I will tell you, the mobile battery you are having. Where do you think this lithium comes from? this lithium is also coming from the mind. Okay, it is not a artificial product that has been made. So when you are mining a product, invariably you are increasing the global footprints of carbon footprints. So it is not like that. Okay, when you are moving into an electrical vehicle, you are making it into a ESG positive company. Now suppose by electrical company, now you are charging that through electricity. What happens when you get the electricity if it is a coal-based power plant? Naturally, you are burning more coal to get that electricity. Okay, it might be clean in your hand, but after all, you are burning coal to get that energy itself. If it is a nuclear thermal plant, we can understand it. But if you are burning more coal, does it make it into equal sense? No, not at all. So we need to understand those things, what we don't know. So we need to understand how much lithium is going into the battery. So talking about ESG, okay, it looks very hunky and dory. Okay, I mean, investing into an ESG company by investing into a battery or battery companies. But let us check out how much goes into those batteries. What are the minerals that are going into the battery? The lithium and other materials and that.
Okay, thanks, Reni. Thanks for being with us once again and sharing your mindset, sharing your investing discipline, sharing your investing stories. We would look forward to have you again later with us and later sometime with us after the war is over, and maybe we can give some great picks, more picks to our audience and our clients. It was wonderful talking to you as always. Thank you for being present today.
Thank you, Vishal. Thank you very much.
Okay, I'm ending the meeting now for all.
Thank you, Vishal.
Goodbye. Goodbye.